Hey guys, hello. So, what we have done till now, we have just early adopted, pardon me, we have just adopted IFRS for the first time using IFRS 1 as a first time adopter. We purchased some non current asset. Now we are entering into transaction for generating the revenues. Previously or now, currently, for the purpose of revenue, dollars and dollars. For the purpose of revenue, now there is one standard called IAS 18, which deals with the revenue recognition concept. And now comes the future. This is the future. This is called IFRS 15. IFRS 15 deals with revenue from contract with customers. This is applicable from the accounts beginning from 1st Jan 2016. 2018. 1st January 2018. So this is the standard. So when we are generating a revenue, you need to apply either IAS 18, or either you are early adopting the IFRS 15 standards. So now, what is the difference between IFRS 15 and IAS 8? That's a very big topic. I will cover IFRS 15 in detail. How much I'll know, I'll definitely share. But IFRS 15 is a very huge area, and some big fours, some not big fours, are primarily involved in making impact assessment on these standards. That's a quite huge impact on multiple organizations. In a nutshell, IFRS 15 just deals with a 5-step model. It brings 5-step model into force. Previously, you used to recognize revenue based upon whether we are rendering services or you are selling the goods. For selling goods, they have one condition for to book when the risk and rewarded transfer. I hope so. And when the cost is certain, when there is a collective reliability is there, and if the conditions are there are 4 or 5 conditions there in the current UK GAAP or current IAS 18. But when you go to IFRS 15, it has a 5-step model. First thing you need to recognize is that whether the transaction you have entered should be a contract. It may be oral and may be written with your customer, and contracts has 5 conditions. Contracts as well as 5 conditions that one transaction need to go through. First thing, you need to identify whether it's a contract with the customers. The second thing, you need to determine the transaction price. Transaction price is the amount of revenue that you are going to book in your accounts. The second step is recognition. Second step is the determination of your transaction price. The third one is, or you can use it as a second one, and determination of transaction price could be a third one. It deals with determination of your performance obligations. What does that mean? What does this mean? It depends upon the contract to contract. And IFRS 15, when I will explain IFRS 15 in detail, I'll definitely go through these areas. Definitely, I'm just giving a touch up now. It deals with the performance obligations. You look, this is IFRS 15. You have a contract, you have a transaction. You need to be should be with customer, right? What you gonna do? You determine the transaction price. Which means the revenue you're gonna book. The revenue you're going to book. Then you will divide those revenue into performance obligations. You will determine the performance obligations. You will allocate. This is step 4. You will allocate those revenues, and now you will recognize revenue of these performance obligations. So this is IFRS 15. So when you IFRS 15, a transaction is there. It should be with your customer. Now you will determine the transaction price. You will allocate the transaction price between performance obligations. you will allocate them in the pure performance obligations, and you will recognize revenue of each individual performance obligations. This will cause a 5-step on recognition of revenue. I will give you the detail of IFRS 15 once I'll go through it. Thanks.